Greetings, Investor Nation, Tasty Nation, and anyone else who wants to learn how to use options for trading or investing. Today, I'm going to talk about the most important options Greek, which is delta. If you don't look at delta when you use options, then you're flying blind, so to speak. But if you do have a pretty good understanding of delta when you use options, you can have a fairly predictable outcome. Okay, so here are the 5 definitions of delta, and I'm using the word definition a little bit loosely here. For the purposes of trading with confidence and having a predictable outcome, these 5 things are true or approximately true for our purposes. So number 1, the gauge of moneyness. Number 2, directional risk or share equivalency. Number 3, probability of expiring in the money. Number 4, the implied volatility or expected move or the 1 standard deviation move. And number 5, delta is proportional to the probability of touch. And that symbol there means proportional. So I got the idea for this from this Tasty Trade slide, which has actually 4 definitions of delta here. And I've added on the 5th one. So if we compare my version on the left to the Tasty Trade slide on the right, you can see they've got my number 1 here, gauge of moneyness. Delta above 50 means option is in the money. Lower than 50 means out of the money. At or around 50 means at the money. I'm going to show some examples of all of these concepts using my trading platform. So number 2, directional risk. Delta is the change in the option value when the underlying moves up by $1. Number 3, probability of in the money. Delta is a proxy for the probability that the option expires in the money. And number 4, standard deviation. The 16 delta put and call strike will tell you the stock's range by expiration. The stock has a 68% chance of staying inside this range by expiration. And my number 5, of course, is just 2 times the delta is the probability of touch. So let's look at examples of all these. Okay, so I popped over into my trading platform here, and I'm going to use the stock HOOD, which is Robinhood, as my example. So here's my options chain here. I've unclicked weeklies and quarterlies, so I'm looking at just the monthlies. So we could look at September, for example, 28 days to expiration, and here I've got my delta column. So the puts are on the right side, the calls are on the left side. Robinhood is trading at 42.62 right now, and you can see the chart here. So that means if you had an option priced at 42.62, that would be exactly at the money. So my concept number 1, gauge of the moneyness. So a put or a call, which has a delta of 50, would be exactly at the money. And since these strikes are only in whole numbers, you can see my closest to the at the money put is around the 42.8 delta, or you could just round it up to 43 delta. And on the call side, it's 53.3, and you can just round it up to 53. So 53 delta on the call side and 43 delta on the put side, we would consider those to be roughly at the money. So that's the moneyness. When your delta goes lower, that would be out of the money. So these puts are out of the money because the delta is lower than 50. On the call side, deltas lower than 50 are out of the money calls. And then if we look at in the money calls, is delta above 50. So these are all in the money calls. And on the put side, these are all in the money puts. Okay, so number 2, the directional risk or share equivalency. So if we were to go and say trade the 31 delta put, which happens to be this strike here, 39, you can say that your directional risk on that is roughly equivalent to 31 shares of stock. So if I was to buy that put, I would be short the equivalent of 31 shares of HOOD stock. And if I was to sell that put, I would be long the equivalent of 31 shares of HOOD. And on the call side, if I was, say, to buy the 39 delta call, I would be long the equivalent of 39 shares of stock. And to sell that call, I would be short the equivalent of 39 shares of stock. So the 39 delta, if the stock moves up by $1, I would expect to make around $39. And if the stock moves down by $1, I would expect to lose $39. So that's your directional risk. So let's go on to number 3 now, which is probability of expiring in the money. I think this is probably the most important definition of delta that I use every single time I do an options trade. So if I was to buy the 39 strike put, which is the 31 delta, I know that the probability of winning on that trade is going to be roughly equal to 31%. So if I go look at my profile here, it's actually saying it's 25%. So this is a low probability trade. I wouldn't want to do this. It's doing a calculation here, taking into account the debit that I'm here. So it's not exactly 31%, it's actually saying it's 25%. But that's why delta is roughly equivalent to probability of expiring in the money. So if I was to instead sell that put, my probability of profit would be the opposite of that. So 1 minus 31 or 69. And it's actually telling me my probability of profit here is 74%. So this is a high probability trade. This is why I would want to sell options rather than buy options. Just because it's a higher probability of success with a predictable outcome. And then if I pop over to the call side and say sell the 39 delta call, it's telling me my probability of success is 72%. And if I was to buy that call, it's telling me my probability of success is only 27%. So again, this is why we would want to sell options and not buy options. Okay, so let's move on to now number 4, which is the implied volatility or the expected move. So if I was to go and look for roughly the 16 delta put, here the 35 strike is actually at the 17.1 delta. And if I go and sell that, and then I also want to sell the call side at around the 16 delta call, which happens to be around, actually let's pick 20 here, because that's pretty close to 16. So now what this is saying is, in the next 28 days, the options market is predicting the price of Hood to stay between 35 and 55 from now till expiration. Most of the time, actually 68% of the time, which is one standard deviation. If any of you have seen a normal distribution or standard deviation graph, that might make more sense to you. I can actually plot that on this chart. That's the expected move cone, and that's based on one standard deviation, which is roughly 16 delta on both the call side and the put side. So that's saying that the options market is predicting that Hood will stay within this one standard deviation cone 68% of the time. And that's based on the options market pricing, which also gives you this implied volatility value of 84.4%, which is actually annualized. So the market is saying that it's expecting Hood to go either up or down 84% for a whole year. But it's giving you different calculations for the different cycles as well, 28 days, 56 days, etc. So this is all based on the Black-Scholes model. And if I show the risk profile of a short put and a short call, which makes a short strangle, it's saying that I will make max profit if the price of Hood stays between 35 and 55 by expiration. If you were to put in a mid price here of 2.1 for a one lot, that's giving me a total credit of $210 as my max profit. This looks like a pretty reasonable trade with a high probability strategy, 75% to win anything on this trade and 65% to win the maximum profit on this trade. And I'm only putting up $736. Any of you that have watched some of my previous videos would know that I'm only actually going for about half of that, so $105, which would actually boost my probability of success. And if I divide that by the capital I'm putting up, that's about a 14% return capital in only 28 days time. That's a pretty reasonable trade. Okay, so moving to the very last concept of delta, which is probability of touch. Probability of touch is a very simple estimate. It's just 2 times the delta. So if I was to sell the 17 delta put, you just take 17 times 2. That's giving me a probability of touch of 34%. So there's 34% chance that that strike, 35, will be touched in the next 28 days. So it's 17% chance of expiring in the money at expiration 28 days from now. But any time between now and expiration, there's a 34% chance that Hood will actually touch the price of 35. So probability of touch is just something that's good to know. So you know kind of what your chances of being touched are based on the delta that you're at. And of course, delta can change over the life cycle of the trade. All right, thanks for watching, and I hope you learned a little bit about delta today. And if you haven't seen my video yet on my delta to theta ratio, make sure you check that out, because that's really how we make money as options traders, is paying attention to your delta and your theta in your overall account. Thanks for watching.